Yeah, I guess my question is, I don't see a lot of fear in the average consumer's eyes about recession right now. In fact, we still are sort of seeing the opposite with this great resignation, where people are still being very choosy about whether they want to go back to work or what type of job they want to take. My concern is that, I could make an argument that in a year's time, we're going to go from a jobs glut to a jobs drought. And all of a sudden, people are going to be, it's going to be the great unretirement movement, right? People are going to be begging for their old jobs back. Those jobs might not even exist if the companies have laid off. So I guess my question is how for people that are entertaining the idea of a recession could arrive, from your just best guess, is it going to be a light one and don't worry too much about it, or is it one that people actually should be taking precautionary action now for? I mean, could it be relatively prolonged? Could it be relatively deep?
I think people should take it seriously. I think that, these things are crystal balls, right? We're trying to predict this, severity of a recession. I think is inherently hard. And I'm not going to sit here in like an armchair and say, this is going to be the third worst recession in X number of years and something that specific.
Yeah,
But basically,
nobody knows.
we look at the combination of there's really not a lot of new energy capex coming online. And supply chains might be eventually improving somewhat as China opens, but I think the energy side is still problematic. And so we have real world constraints about abundance, basically our ability to have more goods and services cheaply. And then the other side of that, unemployment is one of the most lagging indicators. So all of the leading stuff happens first. We've already seen now nearly a year now of deceleration in terms of all those leading things. And we're just starting to see it show up in unemployment numbers, but from a very low base, right? So unemployment looks pretty good. And we're starting to see that slowly get a little worse, but from a pretty strong position. And so I think that as we look out, we'll see tighter financial conditions. Unprofitable companies will have trouble raising equity, right? So they're trouble growing and hiring more people. Very indebted companies will have trouble raising debt, and they might have to lay people off and slow down operations. And so I think that, and then that spirals when you start to get layoffs, you get weaker consumer demand, and then you get poor company performance that can result in more layoffs. And so I think that things that are discretionary in particular face squeezing here, right? So their costs are going up while consumer demand is also weakening. And so I think that can continue spiraling into a recession, and how deep or prolonged it gets then depends on what are policymakers doing, what is happening with geopolitics, right? Is there a ceasefire and maybe we're kind of getting some of the gum out of the system, or is that just getting worse? Right? There's all sorts of variables that are hard to predict 6 months, 12 months, 2 years in advance. And so that's why you can have a long-term outlook. Like I will say that I think inflation is going to be hot for the better part of this decade. That's a very long-term outlook. But that's still subject to kind of a quarter by quarter analysis of what's happening in rate of change terms and kind of monitoring that thesis over time. And so it's not like saying, 2 years from now, this is the exact type of recession we're going to be in, or things like that.
Yeah. All right. So look, given the fact that I'm asking you to sort of prognosticate here, I really appreciate you doing your best there. I want to underscore one point you made here about the underinvestment in CapEx in the commodity space, because that's an exacerbating factor to what's going on here. So, I've heard you say looking forward, part of how we fare is going to be how much development do we put into this space. But we have starved this space in many areas for a decade or more. Talking to Rick Rule, he has basically said, hey, if we just kind of keep things as is based upon the underinvestment that we have done over the past decade plus, we're going to have some severe shortages in the not too distant future in some key commodities. And he was saying that before the whole dust up with Russia and whatnot. The commodity capex right now is less than 1% of GDP. It traditionally is usually above 3%. And a quick stat here: since 2014, commodity capex has sunk 57%, while US GDP is up 34%. So, I look at that and just think, yeah, that's just, if that doesn't change, that's just a mathematical destiny for sort of chronic shortages keeping the input costs of essential inputs high. I'm assuming that's a part of your thesis for kind of high inflation over the next decade.
Yeah, when you filter out most of the noise, that's the main signal, is that we're not bringing a lot of new supply online for natural resources, especially energy, but also more broadly downstream of that, other natural resources. And to some extent, that's how history goes. We have these kind of roughly 15-year commodity cycles. You mentioned Rick Rule. He has that good quote that bull markets are all the authors of bear markets, and bear markets are the authors of bull markets.
Mhm.
Where during periods of high prices, that encourages a lot of new producers to come in. Investors want to give them capital, and then they produce a lot of new supply. They eventually overproduce, and there's some sort of demand destruction that occurs. Then you have this supply glut. And so, or prices collapse, and then nobody wants to put money into the space, and eventually demand keeps creeping up, and we work out that excess supply, and we get higher prices, and the cycle starts anew. So commodities, because you don't control the price of your own product, are inherently kind of a boom bust industry, and it's historically operated on roughly these kind of 15-year cycles. And so we had this period of oversupply, especially in oil. Basically, we tapped into new energy sources. Combination of cheap credit, the willingness by investors to keep funding companies that were drilling while being free cash flow negative in shale. And so we flooded the market with oil, despite it not being particularly profitable to do so. There's kind of an endless willingness to destroy capital for the sake of growth. But eventually that ended up not being truly endless. Eventually investors got tired of that. And then you also added ESG concerns, things like that. And then some large pools of capital are in the impression that we're not going to need those resources in 5 years, which I think is way off.
Misguided.
Yeah, and so I think that it's a normal commodity cycle, but then it's amplified by a few things, including how much debt is in the system, like I mentioned before. And so going through the next commodity bull market with this much debt in the system is inherently going to be inflationary, right? So basically, policymakers are going to have trouble reining in demand, and producers are going to have trouble ramping up new production. I think it's going to take time. And right now, the market still is looking at this as somewhat transitory. They're still pricing oil futures out 3-4 years way lower than current prices. I think until the market wakes up and sees that, sure, the latest wars are adding to this problem, but if they see that the underlying problem is deeper than that, the underlying problem is lack of investment, and wakes up and starts pricing future oils way higher and encourages a ton of new production to come online wherever they can. I think this is going to be a problem for a while, and I think we need a lot of solutions for this, because it's hard to have real growth without energy growth. And we do live in a finite planet, and we do have, some finite resources. And I think it's going to take a lot of ingenuity to bring a lot of new energy online over time.